Hello everyone, my name is Ankita Patel. I'm from Commerce Department of Gajra School, Uttarakhand. Today I'm going to throw a light on accounting and its terminology. Accounting, we have already studied about it, we have already learned about accounting. Accounting is, I could explain more of it on basis of its definition. Definition says as accounting is an art of recording, classifying, and summarizing in a significant manner and in terms of money and events, transaction which impart at least of a financial characteristics and interpreting its results thereof. This is a definition by AICPA. American Institute Certified Public Accountants. In short, I could say in a simple language, accounting is an art of recording business transactions and, and thereby interpreting its results also. So let's see more about it. Characteristics. Characteristics, the first I want to to explain about is financial characteristics. Financial characteristics, business transactions, whichever is happening in a business, that is of sales and purchase, it denotes a financial character. And that's the reason the characteristics of accounting is first denoted, it's only by its financial characteristics, a monetary value. Each and every business transaction has monetary value. For example, a detergent, 1 kilo of detergent purchased for rupees 5,000. So here the characteristic, financial characteristics denotes is the rupees that is 4,000 that has been purchased. The amount, monetary value has been denoted. Second, money as a medium of exchange. Money as a medium of exchange means, here I could say, whenever in a business transactions has to be transacted, it should be in exchange of money only. Then only that business transactions can be recorded. So your money could be only a medium of exchange, not like the previous years in the ancient years where the goods were exchanged for the goods as in barter system. Here, it could be only recorded if the business transactions has been exchanged, the goods or services that has been exchanged only through money. Third one, classification and analysis of transaction. Classification, I could say each and every business transactions that has to be recorded has to classified first and then it has to be analyzed. So first of all, classifying business transactions will be like which accounts has to be debited or which accounts we have to classify first into nominal account, whether it is a real account, whether it is a personal account. So first, each and every transaction would be having more than two accounts. So each transaction and each account has to be classified and then has to be analyzed, that it has to be like which assets has to be for example, I could say analyzing of transaction could be like classified and then analyze of each and every transaction. Analyzing of every transaction could be such that each and every real assets or nominal accounts has to be classified and analyzed. The result should has to be thereof has to be analyzed. Interpretation of transaction. Interpretation of transaction means, I could say each and every transaction has its own interpretation of the results. Like for example, I could say goods of rupees 5,000 has been sold for rupees 10,000. So here the profit that I could denote is 5,000 because the cost price of goods was 5,000 and the sales that has been made, that was for rupees 10,000. So I could say from the results, the interpretation of this transaction, I could say I have sold the goods of rupees 5,000 in 10,000, interpreting the results of profit for rupees 5,000. Quantitative information. Quantitative information means each and every business transaction is measured in terms of numbers. That is, in terms of financial characteristics again. But here, quantitative means it is denoted by a monetary value. So here, each and every business transaction has the characteristics of quantitative information because it is denoted in numbers. Economic decisions. Now, different types of stakeholders take economic decisions based on the accounts prepared by the business owner. So here, economic decisions like, for example, I could say shareholders take economic decisions whether they have to invest their funds in certain company or not on the basis of the accounts prepared. So these were the characteristics of accounting. Now let's talk about accounting terminology. The meaning of each and every terms is very important in terms of accounting. So let's study about it. First one is business transaction. Business transaction means a transaction of sales or goods, purchase, or the profit, loss, each and every, whichever the goods has been exchanged in exchange of money can be recorded as business transaction. Second is capital. Capital is the business owner brings money in the business to start a business. So that will be denoted as, that will be told as capital. Many times business owner brings even capital in form of cash or in form of assets. So both can be classified as capital. Next is drawings. Drawings means, I could say, just like capital, the business owner brings money in the business. Same way, if the business owner takes money from the business for his personal expenses, that could be known as drawings. So here again, business owner can take even goods or the money. So if assets or goods are cash that has been taken by the business owner for his personal expenses, that is denoted as drawings. Purchases. Purchases the goods that has been purchased. Now many times it happens in business, many items are purchased. Just like, for example, a grain trader purchased stationery stock from the shop. But the stationery stock that has been purchased cannot be denoted as purchase. Purchase means, I could say, the goods in which the business owner trades in, deals with for business purposes, that only could be denoted as purchases. Sales. Sales means same way the goods in which the business owner sells the goods only for the business purposes and not for any other purpose, that is known as sales. For example, even if for example, furniture has furniture rupees 5,000 sold by a grain merchant, so that cannot be told as sales because grain merchant only deals with grains and cereals. So here, if he is selling the assets, that will not be denoted by as sales. Sales only will be denoted for the goods that he deals in for the business purposes. The next is the debit. Debit means we are having two sides to record in each and every accounts. So here, debit means the left hand side of accounts that has to be prepared is known as debit. The left hand side is known as debit and the right hand side is known as credit. So whichever accounts you are classifying and you are putting on the left hand side or the right hand side denotes by debit side and credit side respectively. Now let us see more about it, more about the accounting terminology. The next I could say is about liabilities. Now liability means an amount payable by the business owner to its customer or for the or to the person that has been traded in for the business purposes. So liability is, in short, I could say in a simple words, I could say liability is the amount payable by the business owner for the business purposes. So here the liability is also divided into two parts, that is internal liability and external liability. Whenever internal liability means whenever a business owner lends money to the business is known as internal liability. Now you will be shocked here to know that even if the business owner lends money to his own business is also a liability. Yes, I could say, because in accounts, business and business owner both are different entities, so they cannot be denoted as same. They cannot be told as they are same. They both are separate entities, and that's the reason whenever a business owner lends money in the business is known as internal liability. Now, external liability means whenever business owner borrows money from the third party, that is from the outside people, that is known as external liability. Here again, internal liability is divided among two parts, that is current and non-current liability. Now, current liability, I could say, is the amount that has to be payable. It could be within 1 year. Money a business owner has to pay internal current liability to the person only within a year. That has to be termed as current liability. Non-current liability, opposite or contrary to the current liability, that means the amount that has to be payable by the business owner will be for more than 1 year. In short, I could say that could be long-term liability, wherein current liability can be known as short-term liability and non-current could be known as long-term liability. Current, that should be within a span of 1 year, and non-current, that should be more than 1 year. Now let's talk about external liability, current and non-current liability. Current external liability means whenever a business owner has to pay the amount to the third party within a span of 1 year is known as current liability. Now, non-current liability of external is known as the person to business owner has to pay the amount to the third party for more than 1 year. So that is non-current liability. So now let's talk about assets. Means the amount that has to be received or the benefit that a business owner receives for long term and short term is can be known as assets. Example of assets, I could say it could be furniture, it can be plant and machinery, it can be building. All those is going to be affected. The business for a long term is going to be benefited to this business. Of course, we know that even if it is building, the machineries, the technology that has been used by the business owner for business purposes, it will result benefits. It will benefits the business for a long term and as well as for the short term. So now let us see the classification of these assets. First of all is non-current assets. So non-current assets means the assets that has to be benefited to the business owners for the long term is known as non-current assets. Example denoted for non-current assets could be land and building and patent. So this will be beneficial for the business for a long term. Current assets which are beneficial for the business for a short period of time is known as current assets. I could say the example of current assets as of debtors, bills receivables, cash balance, bank balance can be included in current assets. They are going to benefit to the business for a short period of time. The next third part is the fictitious assets. Fictitious assets, I could say, to those expenses which can be benefited to the business not for a very long period and not for a very short period. That is for the medieval period of time that has to be benefited to the business. Now this is not a regular expense. This is not the regular income or the benefits that a business owner serves. So this can be known as fictitious assets. The examples of fictitious assets that is known as the preliminary expenses or the issue cost of a share. So whenever a business owner thinks that he needs more and more capital, he could at that point of time he could issue the shares, the price, the cost expense of that share would be known as preliminary expenses, because this expenses or this assets is not for regular period. It is not even for a very long period as well. So that's the reason it is known as fictitious assets. Now I could say the non-current assets are again divided into tangible and intangible assets. Tangible assets, I could term it as the assets which can be seen and touched are known as tangible assets. Example, it can be known as for furniture and plant machineries. billing, that is all known as to be examples of tangible assets. Intangible assets, I could say intangible assets like patent, goodwill, trademark, that are all the examples of intangible assets which are denoted by like that they cannot be touched or seen, but they can be recorded in the accounts. So those are known as intangible assets. Intangible assets means which cannot be seen, which cannot be touched, but the benefits of these assets are beneficial for the business. And the last part of the current assets is liquid assets. Now, liquid assets means those assets which can be easily converted into cash is known as liquid assets. But here only the terms and condition is only the stock is not included in this liquid assets. So here I could say the example of liquid assets, bills receivable and debtors. Then the next terminology that we are going to talk about is capital receipts. Receipts means I could say the money that has to be received by the business owner. Now, capital receipts, I could say capital receipt means the receipts that is going to be, this receipts is not going to be regular in nature. They are not occurring regularly. So they are, for example, I could say, I could explain with the help of the example. Now, when I sell, as a business owner sells assets. So when the business owner sells assets, that could be termed as capital receipts, because each and every day the business owner is not going to sell his assets, his furniture, his plant machinery and everything. So for that reason, whenever a business owner sells any assets, that could be termed as capital receipts. It is not in regular in nature. Revenue receipts. Revenue receipts are in regular nature, regularly occurring in the business. So whenever any income, like for example, income of bonus, income of commission, that could be termed as revenue receipts. This revenue receipts can be regularly in nature. So they are revenue receipts. Capital expenditure, again, just like the contrary to capital receipts, capital expenses is, it cannot be in regular in nature. But here they are expenses. In short, I could say capital expenses is the expenses of the business. Whenever the business owner purchase any assets, that could be termed as capital expenditure. Now, each and every day he is not going to purchase assets. That's why that is known as capital expenditure. Revenue expenditure. Revenue expenditure are those expenses which are regularly in nature. Like for the example, salary to the managers, wages. So they are termed as revenue expenditures which are regularly in nature. Now, next is the stock. Stock means the goods that has been purchased by the business owner, but then some of those goods are left over to sell. Those goods are known as stock. Debtors. The next is debtors. Debtors I could term to the person from whom the business owner is liable to take the payment. That means he is going to receive the money from the person, and those person is known as debtors. In other words, I could say a business owner sells his goods to his customers, so those customers becomes debtors when this transaction occurs in credit. That means the money that has to be received, it could be for a maturity date, will be having a maturity date. So those customers would be known as debtors. Bills receivable. Bills receivable is also those bills, means a bill will be having bill writer and bill acceptor. So when a bill has been written by the writer, it becomes bills receivable for the writer. Now, bill acceptor accepts the bill and is liable to pay the amount. The specified money has to be paid to the business owner on the maturity date. So those bills becomes bills receivable for the bill writer. Same way for creditors. Creditors means a person from whom, for to whom we are going to pay the money. As a business owner, the business owner is liable to pay the money to the person from whom he has purchased the goods or services on credit. That means a business owner has to pay the specified amount on the maturity date as per mentioned to those person. So those person becomes creditors for this business owner. Bills payable. Bills payable is the bill that denotes that the person has to pay the money. Here itself, bills payable with the business owner denotes the business owner has to pay the money to the people from whom the goods has been purchased for the business purposes. So that would become bills payable. Okay, so next we are going to start about discount. The next and important one of the important term in accounts is the discount. Discount means whenever transactions occurs in business for even for sales or for purchase of goods, sometime some amount of the total amount is been deducted. So whenever that some amount is deducted, that is known as discount. Whether it is for business, whether the transaction is purchase in nature, whether it is for the sales, the amount of deduction is known as rupee discount. Now here there are two types of discount I would like to say about is trade discount and cash discount. Trade discount is most probably like when the business owner purchases or sells the goods on bulk in a very huge quantity. At that point of time, they are liable to likely to get trade discount, but it is not compulsory that each and every time they get trade discount. But whenever they receive trade discount, that means this trade discount will not be recorded in accounts. They has to be separated from the main amount before recording in the accounts. That has to be observed. Means trade discount is to be observed. You can observe the amount, but you cannot be recorded. That means, for example, I could say a business owner sells the goods of rupees 5,000 and receive 10% trade discount. So whenever the business owner writes in his accounts this transaction, he has to write the purchase of goods of rupees 5,000 minus 10% would be 4,500. So business owner directly writes the amount of goods purchased of rupees 4,500. He will not be mentioning of 10% trade discount in books of accounts. The next thing is cash discount. Cash discount means whenever the deals happens for purchase and sales, the amount deduction been given whenever the business owner gives the money or receives the money at the same time. So that would be cash. Whenever the transaction happen in terms of cash, that would be no that at that point of time some amount is given as discount. So that would be known as cash discount, and this is recorded in accounts. Now the next two things more important in discount is discount received and discount allowed. A discount received. Now discount received, I could say business owner receives discount whenever he gets the goods purchased. So when the business owner gets the goods at the same time along with the cash discount, that means he is going to receive the discount. Now the same way, in the other way, I could say discount allowed when the business owner sells the goods at a discounted rate. At that point of time, he is allowing the discount to the person who purchased the goods. So when the purchases are made, discounts is received by the person, by the business owner, and when the same business owner sells the goods, and at that point of time he is likely to be given discount, and that is known as discount allowed. Thank you.